Lance, welcome back to the show.
Housing. There's always so much going on in the U.S. housing market.
Well, it looks like home prices are falling.
In more markets, that is absolutely the case right now. Zillow's home value index, which is one of the major home price indices out there that helps to get a little bit of a gauge for mix shift. So unlike just an average price or just a median, and they're looking at the middle of the market. And so of the 300 largest metro areas that they track, 31 were down year over year in January. In February, that jumped to 40 something. And then this month, it jumped, that was reported for March, it jumped to 60. I expect it's going to be well over 100 pretty soon for the number of markets down year over year. And the national rate for Zillow's home value index a year ago was plus 4.6% year over year. Right now, it's plus 1.2% year over year, and that's actually rounded up to 1.2. And Zillow's economist, they were expecting that national home prices in their indice would rise this year around 2%. And now they're expecting home prices to fall over the next 12 months, 1.7% year over year. And so that would have us at the first annual down year being 2025 since the housing market bottomed back in 11-12. So 2011 would be the last annual down year.
Yeah, well, a lot to dive in here today. You're a housing data analyst. Your company, Resi Club, is tracking, these housing market metrics. For those, Lance, that don't know who you are, if you could just give them a quick rundown on your background, and then also tell them, what is Resi Club?
Yeah, so longtime financial and data journalist. Had worked at places like Bloomberg. Was the real estate editor at Fortune magazine for 4 years. Worked at Realtor.com for a couple years. Really got deep into the data. That's where I got more of my housing analyst hat. And back in the end of 2023, given just that this was such a big moment for the U.S. housing market, given how much affordability has deteriorated, given just how low existing home sales are, and just how hungry people are to understand what's going on in the housing market, how it varies across the country, I founded Resi Club in October 2023, had left Fortune, and we're a news and research company that focuses just on the U.S. housing market, what's going on across the country. We dive really deep into the home builders. We have great connections across the housing market, from the home builders, the institutional groups, to just figuring out what's going on in the housing market and being able to really distill that very quickly for people. So we have lots of charts, lots of maps, lots of visualizations.
Well, I know you're highly regarded in this space, and you've been on our channel several times. All of your links are in the show notes below. And, talking about the home builders, which we will talk about here shortly, I think you're one of probably the only ones that they talk to that are out there that are covering the housing market, where you get to talk to these home builders. They're high ups, they're executives, and so looking forward to seeing what some of that information you have further in the show. But let's with that Zillow, talking about the Zillow predictions, and what I guess what's interesting for me as a real estate broker is to see that, a lot of these economists are changing their tune. And, I don't think anyone, we've been talking about this unsustainable, housing market with like you said, the unaffordability is off the chart. And, somebody that myself has been serving the housing market for decades, I knew something had to happen, but now we're seeing mainstream media start to address it, and economists that were, really talking a different tune a year ago are now starting to all get on the same page with, and we're seeing the map, and your data is showing that, in fact, we are seeing price declines. But let's pull up this map, Lance, and maybe you could just talk about it, kind of explain the Zillow map that you've posted, and it really shows this wave of orange color coming from the west to the east and coming up from the south. But let's take a look at that.
So this map is the change in metro level home prices since each metro's respective peak in 2022. And what you'll see is that some markets in the Midwest, Northeast, are up above their 2022 peak, while a lot of the Sun Belt and West are below their 2022 peak. But what played out here kind of varies. And so if you go all the way back to the second half of 2022, there was very much a correction going on where the market was absorbing that very big mortgage rate shock. And so the western part of the US, which is more rate sensitive, and they're rate sensitive for two different reasons. One is they have a lot of tech, which the tech industry is a more rate sensitive industry. And so when rates shot up in 2022, tech stocks were really pulling back hard. A lot less VC money was moving out, and it was more, people were scared out in the tech industry. And so that makes those housing markets out west more rate sensitive. The second part is that out west, there has been a more acute uh, lack of inventory for a longer time, and home prices relative to incomes out west are much further stretched. And that's been the case for a long time. So even when mortgage rates went up in 2018 into 19, the Western housing markets in particular, like San Jose, was more impacted because they're more rate sensitive. So a lot of these declines out west, uh, especially the West Coast, date back to the second half of 2022, where there was a lot of blow off the tops and home prices fell in a lot of those markets, let's say around 10%. Now, since then, more of them have kind of stabilized, although we are starting to see inventory build more in pockets of California now. And some of these markets are starting to see mild declines again. Phoenix is a little different where they were very much in that, second half of 2022, home prices rolling over. But their macro picture for that market is different, where it's not necessarily that they're just a rate sensitive market. It's also that they had a much bigger boom in Phoenix, right? Home prices went up a lot more in Phoenix. There was a lot more domestic migration coming into Phoenix. There was also more speculation, in particular, like the iBuyers. And a lot of the iBuyers were, over their skis in the second half of 2022. They had to sell off a lot of that inventory. They cut down prices. When I talked to Redfin's CEO Glenn Kelman, he had just told me bluntly that whenever you get in an environment like that and you're an iBuyer, you have to sell, right? You have to sell that inventory. You can't hold on to it. And so every couple of weeks, they were cutting home prices by 2% if they weren't selling. And so they were just going down, down, down into the second half of 2022. In 2023, Phoenix started to stabilize more. And then what we've seen since then in 24 and into 25, we're seeing the active inventory in Phoenix building again. And now home prices in the Zillow Home Value Index for Phoenix are rolling over again. And so it's back down to 10% from its 2022 peak. In the Gulf area, more of those markets were stable relative to the drop that some of the markets out west had seen in 2022. Yes, a market like Austin was very much falling harder or just as hard as a Phoenix or Boise in the second half of 2022, but many other pockets of Florida and the Gulf weren't necessarily going down as hard then. But over time into 23, 24, and now 25, the Gulf areas and more of the South have softened more and more. And you're seeing more markets move into what I consider correction mode. And for Florida, a lot of that's driven by the fact that home prices in Florida went up more than everywhere in the country during the pandemic housing boom, with only a few exceptions. And a lot of nationally, home prices went up 40, 50%. If you go through Florida, a lot of areas are up 60, 70, 80%, 90% from March 2020. And so that coupled with the fact that there's an echo pen, housing boom that's playing out in the insurance market where home prices and construction costs went up 40, 50%, and in some areas of Florida, 60, 70, 80%. And so the cost of replacement when a home gets damaged by a hurricane or whatever happens is much higher now. And so insurance, there's upward pressure on the home insurance. And so you have seen over the past 2, 3 years, in a lot of these areas in Florida, not only has insurance went up 70, 80%, some pockets 100%, 120%. So that has really stretched affordability additionally.
I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show.
And then in Florida, during the pandemic housing boom, you saw a huge jump up in, and I'll actually pull up another chart here. You had a lot of people moving into Florida during the pandemic housing boom. And during the pandemic housing boom, Florida's net domestic migration in a lot of 12-month periods was up over 300,000. And I'll show the chart here. Okay, here we go. This is net domestic migration to the state of Florida. So this is the number of Americans moving into Florida minus the number of Americans moving out of Florida. And what you see is during the pandemic housing boom, it soared. It soared above its previous booms. And then since then, it's really rolled over hard. And so between July 2021 and July 2022, there were 314,000 Americans on a net basis that moved into Florida. Over the past 12 months, July of 2023 to July 2024, that's just 64,000. So for every 5 that were moving in during the pandemic housing boom on a net basis, there's just 1 now. And so why that matters is that your housing market now has to rely, in more of these Florida markets, on local incomes to support where prices got to, right? And that's where there's a greater mismatch because home prices went up even more in Florida during the pandemic housing boom. And so they have to now rely more on local incomes. And those local incomes relative to home prices have gotten far more stretched than other markets did during the pandemic housing boom. So that creates a greater demand shock on the market. The other thing for Florida is the Surfside condo collapse. Following the Surfside condo collapse in June 2021, which killed 98 people, Florida passed a bunch of new measures, and those measures are trying to stop deferring maintenance on these older condominiums along the coast. And so that's putting upward pressure on HOAs. It's creating these sky-high special assessments, and that's created this really big shock to Florida's condo market. And here you can see Florida condo prices year over year for the markets that have enough condos to make a good sample. And almost every market across Florida is down for condo prices. And if you go and you're looking at condos built in the 70s and 80s and 90s, there's a lot of drops that are not only 10%, 20%, but 30% for some of these older condos in Florida. And the other thing is Florida got hit by Hurricane Ian in the second half of 2022. That's the third costliest hurricane in U.S. history, and that caused additional softening in Cape Coral, Punta Gorda, Naples, some of those markets south of Tampa. Florida also has, and this part's actually true across the Sun Belt, is that they have more new home construction, right? More multifamily building, more single family building. And so as that supply that was financed during ultra low rates goes into the market, especially on the multifamily side, it creates an additional softening on the market. And for single family, what it does is the buyers who would have otherwise looked at existing or resale, they're now looking at the new builds because the builders like a D.R. Horton or Lennar or Pulte Group have these much bigger affordability adjustments they're doing because they're trying to move that supply into the market. Some of that is smoke and mirrors, right? So you don't necessarily see the price cut because they're trying to keep up comps and it's hard to see what they're doing. But they might be doing, they might be throwing down $50,000, $60,000 to buy down the rates, or they might be giving money back at close. And so Lennar right now, they are doing 13% sales incentives rate. So that means on a $400,000 home, if my math is right, they're doing around $52,000 in incentives. During the pandemic housing boom, at the height back in Q2 2022, Lennar had a sales incentive rate of like 1.5%. And so on a $400,000 home, they were doing around 8K in incentives. And their historically normal rate is 5-6%. So 13% is very high, and it's the highest rate for sales incentives that Lennar has done since 2009. But as they do that, and it pulls the attention of that buyer from the resale existing market to new construction, it creates that additional softening in resale and existing, and that resale existing seller has to, it takes longer for them to sell, right? And so that active inventory begins to build and kind of even additionally pulls that supply demand equilibrium power more from sellers to the buyers. And then, of course, and I kind of touched on this earlier, is the home insurance shock. You can see this map for Florida. The non-renewals are much higher for Florida, and also the insurance, how much it's gone up, is much higher for Florida. And so that's the unique thing for Florida. And you'll look at this map and you'll see that Miami here is still 6% above the pandemic housing boom peak. That is true. But it's also true that now, on a year over year basis, if you look at this 1 year change, Miami's actually down now for home prices. And it started in the condo market, but it's now moving in to the single family market as well. And it's starting to soften more. Now, if you move up into the Northeast and Midwest, I do still expect those places to see some very mild levels of appreciation this spring, as of right now, like these next few weeks, and so I think they'll still finish up on the year as long as there's no larger economic shock to the economy, right? If we were to go into recession over the next 6 months, that call that I just have here, take that off the table, right? It could be a different ball game. But just based on where active inventory is coming into the spring, I still expect them to see a little bit. But that is even changing. And so even if you look across the Midwest and Northeast, they are starting to see inventory rise. They haven't seen it rise as much as you've seen over in the Sun Belt and the West and the Mountain West in particular over the past 3 years, but they are starting to slowly build out of that really big inventory deficit that we saw during the overheating during the pandemic housing boom.
Well, and let's keep that map up for a minute, please, because I want to just ask a couple questions about it. A lot to unpack here, but I can tell you that I track the DMV, or what Bright MLS will call the Mid-Atlantic region. And this covers where we are in Maryland, Pennsylvania, Virginia, D.C., West Virginia, Delaware, New Jersey. So it covers a pretty broad, Bright MLS, what we have a subscription to, though I'm not licensed. I'm only licensed to sell in Maryland. I do keep tabs on them because in these other areas, because I have the access. I have the direct MLS access. And what we're seeing, especially here in Maryland, is a lot of contracts falling through. So a lot of what you're talking about, we are still seeing, multiple offers on properties if they're priced right and they're in moving condition. A lot of the markets here in Maryland, we are seeing still multiple offers and prices going over list price. Of course, that's subjective because what's happening is smart agents are talking to their clients saying, look, let's price it a little bit lower than the market and, than the comps, and then let's get that activity. So yes, we are still seeing where some markets are selling over asking price, but we're seeing a huge amount of price declines. The houses that don't sell within the first week are, we're looking at many of the markets anywhere from like 25, 27% to even as high as 40% in some markets where the active inventory has experienced at least one price reduction. But more disturbing than that are the days on market. They're rising. And as well as that, we're seeing a lot of contracts fall through. And I'm especially seeing this in the last week where we're seeing where something went under contract, went into pending status, and then there's a back on the market. And this could be many reasons, but usually If it's early on, when it falls through, it's typically because of a home inspection, maybe that didn't go the way the buyers wanted, and the buyer and seller couldn't come together on that. But let's pull that map back up again, because I just want to look at, um, so what you're seeing is you're still seeing some of that lighter, um, you know, almost peach to orange color scattered through in a lot of those, northeast areas, and even seeing some red in a couple of these spots. But Lance, so with what, just so everyone knows, and these numbers, these 15 to minus 15%, don't really line up. I think there's, that it's kind of hard to see. I guess the red is over 15, negative 15%. But so just so everybody understands this, we're talking about current prices, home prices, compared to where they were in the peak in 2022, probably in the spring, most of these markets. What says March of 25, obviously. But so
That,
is it fair?
at March 25, that's the bubble size for active inventory today.
Okay, so but what we're looking at is, when we look at this minus 15%, or like in Austin, minus 23.2%, that's 23% price reduction from what they saw in the peak of 22, correct? So
Yeah,
that's today's or March pricing compared to pricing in 2022.
exactly. So using the Zillow Home Value Index for homes in the 35th percentile to the 65th percentile, so in the middle of the market, the typical home's value today is 23% lower than it was when Austin had its peak in May 2022. So and so on it, for comparison here, U.S. peak to trough, according to Case Shiller, national home prices fell 27% during the Great Financial Bust. So the '06, '07 to the 11, 12. And so Austin is already almost there at 23% from the peak. Now, one thing that makes Austin a little unique is that home prices were running up so quickly, so fast. I mean, they were up 40% year over year at one point in Austin in 2021 into 22. And so there wasn't that many buyers who got in at the very peak of that spring market because it was accelerating so fast. So when it had the blow off, there wasn't a ton, but there are some that did experience that, some investors. And if you're in the areas that are, nearby where these builders are putting in, a lot of the single family development, some of the areas of the exurbs in Austin, some of those areas are down 30, 35%. And the builders, a lot of them cut prices at the second half of 2022, just ripped the band-aid off and did 10, 15, 20, 25, 30% in some of those areas just to quickly meet the market. And then even after they did it, as the market kind of continued to soften and was in correction mode, some of them had to go back and do even additional cuts from there. Now, and when builders do cuts, it can all be a lot of smoke and mirrors where it's a net effective cut at around that area. But it might not be it might not be a price cut that you see right on the price tag, right? Because they do things, buy downs, money back at close. I've talked to some investors where uh, the and this is a very large publicly traded builder that did this with them. They agreed to a price, right? And then they gave them back like 60, 70 grand at close after they purchased the home, just so they could keep that comp listed there. They went into the county records.
That's crazy. Yeah, I don't, what state was that? Do you know?
I can't give you everything on it.
All right.
But I can tell you this, that I have seen the contract for that one because
Yeah.
I wanted to make sure it was a real thing.
Yeah. So for just some reference, any idea of the Austin price jump from 2019, or just say 2020 through today, or through the peak? Was that So through the 22, I guess not through today, but through the peak in 22, Austin, what was that total? Okay, 5-year change, was that 30%? Is that what
Yeah,
you just
so
said?
it's down to 32%, but here's the wild thing, is that it was actually up 70%.
Okay,
Uh,
that's the number. So up
March.
70%. Now it's showing a negative 23%. So it's still way up from pre-pandemic
Yeah.
or at that level.
Now you're probably like, "Lance, how it was it up 70-ish percent between March 2020 to May 2022, and now it's only up 32% from March 2020 to March 2025?" And the reason is when home prices fall something like 23%, that takes off a lot more than just 23% of gains. When you fall 20%, you actually wipe out around 30% of the gains. So when you fall 23, you end up wiping out well more than 30 percentage points of the gains. Is kind of how the math works. So just like when you fell 27% peak to trough for national prices back between '06, '07 to 12, you actually had to go up way more than 27% to recapture that peak. And so Austin, to recapture its May 2022 peak, it would have to go up well over 30% to get back there.
All right. The question that I have before we go on, because we're going to dive into this new list, this new market list that you have where, it's increased substantially. But before we do that, where price reductions are, really starting to hit nationwide, still focused in a lot of the sand states. But is there anything in your, research that you're doing here that is looking at the areas that we're seeing the largest price reductions now, or just looking at this map, is there anything that's saying 2007, 2008
Well,
all over?
yeah, so I'm not gonna, I'm not gonna jump to the great financial crisis. Because the great financial crisis, they had uh they also had unemployment shoot up, right? So you had that additional you had that additional demand destruction from there, right? You had all of the bad loans that were made. And so you had a lot of people really stretched in terms of, they didn't have much equity already to start with. And so when prices fell, they were in a much dire situation, right? Whereas this cycle, you've had less of that, and you had so much housing demand during the pandemic housing boom that the ones who did actually get to transact, many of them had very high credit scores, right? So I think there are some, different things that aren't quite there. But I think what is absolutely, that I can say definitively the case, is that this is the weakest spring market, and actually just it looks like it's going to be the weakest year for housing in general since housing bottomed out in 2011. That I can tell you. And the appreciation that we're seeing so far this spring is, if you had to compare it to a year in particular, more closely resembles 2010 than it does anything we've seen more recently. So what we had happen is that we saw prices fall January, February this year. That's not too abnormal to get the prints, but we also saw home prices only rise month over month 0.2% between February to March. Historically, you average around 0.6% for those. And so years where you see less appreciation in the spring, or very faint appreciation in the spring, those usually end up being your weakest years. And then in the back half of the year, when you do normally see those month over month declines, that's where you can get in a situation where if you didn't have much appreciation in the spring, you get that, those negative declines at the second half of the year, and then you can end up down annually on the year as a whole. And so if you seasonally adjust the month over month prints between February to March, what you get is that half of the US housing market saw a month over month decline between February and March. That's not normal
Yeah.
for this time of year. And you're starting to get it to where you have enough bigger markets starting to be down year over year for prices. Atlanta, Dallas, Phoenix, Miami, Tampa, Jacksonville, Phoenix, San Antonio. And as you get more of those large metropolitans down year over year, you can get yourself in a situation where nationally you could see national home prices fall for calendar year 2025. And at least the index that's looking most likely to get there right now is the Zillow Home Value Index, given that it's only up 1.2% year over year, and we're seeing such weak spring appreciation.
Well, let me take us down a walk through memory lane for a minute. Now, I want to pull up this publication by the FDIC Quarterly, and it was published in 2009. The 2009 Economic Landscape, the Sand States Anatomy of a Perfect Housing Market Storm. And I want to just kind of go through here and just talk about a couple of things. It says the housing downturn has been most acute in 4 states: Arizona, California, Florida, and Nevada, that had experienced some of the highest rates of home price appreciation in the first half of the decade. Kind of looks like the map that we just looked at in a lot of ways, but I just want to, and we can talk about it. So it says rapid population growth in the Sand States propelled housing markets. For many years, rapid population growth in the Sand States spurred higher than average rates of home construction. Favorable weather and relatively affordable housing are 2 factors that attracted retirees as well as younger families to these states. In the 1980s and 1990s, population growth rates in Arizona, Florida, and Nevada were between 2 and 4 times the national rate. Certain parts of California, such as Riverside, San Bernardino metropolitan area, experienced similarly high rates of population growth. Rapid population growth continued into the early years of this decade, talking about the early 2000s. From 2004 to 2007, Arizona and Nevada ranked as 2 fastest growing states in the nation, followed closely by Florida, which was ranked 9th. So before we kind of go further into this, any now kind of listening to this, are you seeing any similarities of some of these areas that are showing the earliest price declines?
Well, so that's the part that is similar to that cycle. And so I'm not one of those who's like, hey, there are no similarities to the previous cycle, because there absolutely are. The net domestic migration boom that we saw during the pandemic housing boom, that was actually very similar to what we saw in '03, '04, '05. To those who remember and are fluent in the data, right? You saw a lot of those people burst out of those higher cost markets like New York, Seattle, and some of these Northeast Midwest markets as well, moving into these Sunbelt markets. You absolutely saw that, and you saw prices in those markets go up even more. Right, there was a big boom into those. Actually, kind of ironically, the biggest exception to that was that a lot of the Texas markets did not see as big of a boom. The Dallas, Austin, San Antonio, whereas this cycle, those markets have been at the very fronts of it, right? And so Austin, and this is kind of wild, but Austin only saw home prices during the housing crash cycle fall 8% from peak to trough, and they're already down 23%. But Austin also did not get over its skis in terms of prices going up a lot, and didn't see as much of the boom bust as a Las Vegas, Phoenix, Fresno, for those who remember, and a lot of those Southwest Florida markets during the previous cycle. So that part is very similar to the previous one. I think if you were going to break it into thirds, there's the boom part, right? Absolutely. Where you saw that cyclical big surge in and migration and prices go up even more in those Sunbelt markets, and they had a lot more construction, right? That's the similarity of the cycle. The other thirds that we haven't seen as much, at least yet today, is actual unemployment breaking, right? The economy seeing unemployment surge, right? And that creating additional demand destruction. And then the other third that hopefully we don't have this cycle has been on the actual the debt, right? Where you had the ninja loans and all of that stuff. The last cycle, people already had much less equity in their homes. The people, if you look at the credit scores this cycle versus the last cycle, fairly different. And and if you look at just the overall economy, the amount of disposable income that's going to port mortgage payments this cycle versus the last cycle, we're not as stretched as we were during the last cycle. But you are right that the migration part, the boom into these Sunbelt markets, the construction in those markets, that's the similarity to that cycle.
Well, let's read this part, the tipping point. So it says imbalances lead to housing collapse. And again, this is in 2009. So it continued to decline from there, right? So a lot of what I think what we saw with the unemployment rates, the high unemployment rates were really after 2008, after 2009, at least from my remembrance of that. So in the early on part of it, we didn't really see a high unemployment rate. But let's look here. It says ultimately the housing boom in the Sand States proved to be modestly a mirage. The first signs of trouble came in the form of sharply decelerating rates of home price appreciation, which we're seeing now. It says between 2003 and 2006, annual home price appreciation rates in these states had consistently exceeded the national average. Year over year, house price appreciation in Nevada peaked in 2004 37%. In Arizona and Florida, appreciation peaked in 2005 at rates more than twice the national average. Since then, average home prices in the four states have declined between 27 and 38% from their peak. This sort of looks like a lot of what we're seeing starting to happen here. It says price declines have been most severe in metropolitan markets such as Phoenix, which is red according to the Zillow chart, and Las Vegas, which registered the largest percentage declines in the nation at 34% and 33%, respectively, during 2008. It says as home prices slumped, foreclosure activity rose at a startling pace. It says while the phenomenon was occurring across the nation, it was most pronounced in the Sand States. Now, before you go any further, I just want to show this was a Yahoo Finance article that happened that was posted on April 19th this year. This Florida metro is foreclosure capital of the U.S. Here's what's behind the crisis. It says the state's Lakeland region has the largest highest foreclosure rate in 2024 among metro areas with at least 200,000 residents. According to a real estate data firm, Adam, 1 out of every 172 housing units had foreclosure filings. And before we go any further with that, I'm just stating the obvious. We have suppressed foreclosures this go round way more than I think ever in history. With the modifications, they're still doing it, and I think they're trying to get VA to continue this or extend this loan modification for veterans because there's still a massive problem where people aren't paying their mortgage payments on time; they're falling behind. So I guess and to your point about the liar loans or the ninja loans or whatever it was, FHA's done a pretty good job of being the subprime lender. If you look at what their requirements are for credit score and money down, I mean, and they write a lot of mortgages, probably a lot more than they were writing when we had all those other loan products.
So, a few thoughts, which is that forced selling it moves the supply demand equilibrium significantly for housing. And the reason that forced selling has such a great impact is that most transactions in housing, somebody sells their house and they go buy something else, right? So they're a seller, there's some supply, they're a buyer, there's also some demand. Whereas a forced seller, they're walking away from their house, right? So that's supply into the housing market. Some of them go to live with relatives, some of them go to rent. They're not additional purchasing demand usually, and they don't have the credit to do it anyway, right? And so when you have that supply of forced selling, it puts additional downward pressure on the market. And so the last cycle, when you go through that boom bust, right, which is kind of similar in ways to what we've seen this cycle, going through the boom bust, and then you have all of that forced selling that occurs, and you have the additional demand destruction that comes from unemployment, it moves those supply demand equilibriums even further and puts more additional downward pressure on prices. And so the last cycle was a correction. And then in some ways, it was an overcorrection because you had the cascading downward pressure on prices from all of the foreclosures, right? And so that's how by, 11, 12, we got below the cost of replacement for homes where homes were valued less than it actually was to build them, right? And so that's why there was like this economic opportunity for buying single family rentals, which really spurred the institutional class that came into single family housing.
Well, the institutional class was handed the single family housing by the Obama administration when, they, bundled up these defaulted mortgages, these bank owned properties, and basically threw them over to the investors with the requirement that they had to rent them for at least a year, hoping to rent them to the same people, not in the same houses, that lost their homes due to foreclosure. But I mean, we're still talking about, you just explained some forced selling that was taking place as a result of the iBuyers that were dumping properties. Now we have a lot of home builders with inventory. They're forced sellers. There's a lot of inventory right now that they're discounting to push out the door. And we're sort of at the end of the road of, or maybe not, but saving people from foreclosure, which we never did before. So had we not modified and modified and remodified mortgages and taken 30% of their balance of the loan, cast it on the backside in a double note during, from 2020, 122 onward, or even earlier than that, prevented people from needing to make their mortgage payment altogether. I mean, what kind of a state will we be in? And what about these people that still aren't getting it right? I mean, I think we're at the.
And so with foreclosures right now, we are going to see it tick up over this next quarter that hasn't been reported. I've seen some preliminary data, and the reason is that the VA is now allowing foreclosures to move forward. And so that was a chunk that wasn't there. And we'll see if some of these ones in FHFA come in. But right now, we're still kind of working back to pre-pandemic. Of course, we had that whole period during the pandemic where they pretty much stopped foreclosures altogether. And then we've had, uh, we've had a lot of these extensions and even the past year where they didn't have the foreclosures on VA. And so I'm not saying that it can occur and that.
What about the selling, the kicking the can down the road? We're seeing, massive loan amounts, tens of thousands of mortgages that were non-performing loans, NPLs, and reperforming loans, RPLs, being sold into the investor, the Wall Street market. The big institutional buyers are buying these mortgages from Fannie Mae and Freddie Mac. They're not foreclosing on these houses. They're kicking them to the institutional buyer again. That is just, putting hundreds of loans in each sale. In a lot of cases, sometimes 1,000 or more loans in each sale into the hands of these institutional investors. They're going to kick these people out and have their houses. So, I mean, what about that? We're not seeing any of that.
Well, so I'm not saying that the, spike can't happen in the forced selling. I think it just, we would start to see more of it happen. Now, it could go parabolic where you had '06, '07, and then it shoots up really fast, right? For the 30-day delinquencies here. And so 30-day delinquencies lead the 90-day delinquencies, which lead the foreclosures. And you have seen more of a jump up here in the 30-day delinquencies, where we're back to pre-pandemic levels, not back to it yet for the 90-day. But if you look at credit card and auto, you have seen those really move up well above pre-pandemic levels. And you are seeing mortgage move up as well. And this student loan number here for delinquencies, it's about to skyrocket. In the
Mm.
real world, it already has. It's just taking time for it to get reported. And that is getting reported. And there are some people who would have liked to buy in 2025, 2026, and maybe even 2027 that are not going to have eligibility to do so because they didn't think that all these student loan payments they haven't been making would come back to bite them. And it is now. It's getting reported to the credit agencies. And so you had this period where during the pandemic housing boom or during the pandemic, the lockdowns, right? People weren't paying on their student loans because they didn't have to, right? The government said, hey, we're worried about the economy. Don't pay your student loans. Don't worry about it. Then we had a period where politicians led people to believe that their student loans were gonna be forgiven, right? And so all of
Yeah.
that incentivizes people to not pay their student loans. And so people started to think that that debt was imaginary, that it wasn't real. And now they I mean, people are supposed to be paying their student loans now, and they have and some of them haven't been, and the delinquencies are much higher than are what are officially reported. And now that's actually getting reported to the credit agencies. And so the New York Fed put out a report where a lot of people are going to see their credit scores go down 140 points as these get reported in.
Mm.
Some people more than that.
Wow. Yeah, and then I think it was January. I think the medical debt has skyrocketed too. People that have gone and to seek medical attention and haven't paid their bills. I know that I think it was January 25th or something. They just eliminated the ability for that to be reported on credit reports. But yeah, you're right. I mean, it's talking about I have lenders that tell me one credit card payment. If you miss one credit card payment on time, it drops your credit score like 100 points, something unbelievable. And for these people to try and obtain a mortgage, it's going to be tough. That's
One more thought I want to give on the foreclosure stuff, which is
okay.
if it starts to be a problem, it would be the vintages of late 22, 23, 24, 25 that would be more the problem. And the reason is those are the people that are much more stretched relative to buyers before. And so, one unique factor this cycle is because mortgage rates went so low during the pandemic housing boom. A lot of them, got refinanced down to a two something handle. And when you're getting a mortgage rate that low, and the way these are amortized is that when you get down to a 2% something rate, your amount that's going to principal right off the bat is very high. And some of these people, it's 50% right off the bat to principal once you get down to that low of a rate. And so the actual equity built in, unless these people are getting stretched on things like credit card and auto, which very well could be the case for some, it gives them a bigger uh, uh, LTV.
So when you're talking about the people in the two handle, are you talking about refinance or new purchase?
Both, yeah.
Yeah, I didn't know that refinance was as low as 2%. I know that new purchase was in that range, but you're saying refinance was down in the 2% as well?
High twos, yeah, for
Yeah.
some people, yeah.
Yeah.
Especially
The
and even a and yeah, I'd need to go back and check, but yeah, I'm pretty
yeah.
sure the refi is still some of them in like the 2
Yeah.
9. But
I know traditionally refi is higher than your new purchase. Traditionally speaking, I don't know what people were getting. I do know people that were down in the 2.6 something new purchase. Certainly a lot of people that were in the 2.7s. But yeah, on buying. But that's the homes were priced at that level. Now they're priced at the 2 handle, 3 handle. and we're at
And
7%.
that's why I say that if it becomes more of a problem, it's these
Yeah.
vintages of late second half of 22, 23. Now, if you go back to the last cycle, that was also a bit of most of the case the last cycle as well, where the
Yeah.
vintages that became the problem were the '04, '05, '06, '07, right?
It's amazing, and you're right. I mean, you're exactly right, but it's amazing how many people reach out to me and send me emails and call and they say that their mortgage is completely paid off and they can't afford to live there because of like what you said, their insurance has either been canceled or and they were devastated by they don't have the money to rebuild after a hurricane or they lost everything they had or but with the affordability, the property taxes are burying people. I mean, you have people that are, their mortgage has been paid off for 10 years or 20 years, and their property taxes, because of this price appreciation in a lot of states, have pushed them to where their fixed budget on Social Security isn't enough, and the taxes are more than their entire Social Security check. So they're, we're seeing more 70-year-olds going back and getting jobs. They're incurring a lot of this credit card debt. The over 70s credit card debt, I think, is at the highest levels it's ever been. And, so people are, it's not just our young people that are getting clobbered. It's our older people that were hoping by the time they got to 75 years old that they would be able to actually retire and live the rest of their life, and not have to
So,
struggle with
and it's
finances.
not just them that gets affected by the higher carrying cost. It's also some investors, right? Where, you could get to a place where if the carrying costs move enough for the home insurance, the property taxes, uh,
Repairs.
that can take, yeah, exactly. That can take some of these investors from a place where they're cash flowing to a place where maybe it's very minimal cash flow, or maybe it's even an alligator property. And they're like, you know what? This isn't what I signed up for. And they're walking away. And you have seen some of that in Austin, where some of these investors during the pandemic housing boom were buying properties that did not cash flow, had a slight negative
Hmm.
cash flow, were alligator properties, and were only buying them just because of appreciation, right? They thought it was just going to continue. So they were speculating.
Which is '06.
Yeah. And so Austin did see real speculation this cycle. And
Yeah.
I mean, there obviously there's investors doing that. Um, and
Well, Lance, let's talk about the chart of 60 that you have because I do want to get your opinion on that. Geez, man, this you just have such up-to-date data on what's going on. Kind of explain to us what is happening with this chart.
yes. So give me a second to find it.
And while you're doing that, I can remember I was in Orlando and right in the middle of all the GFC and things were going nuts. I mean, you could buy a 2-bedroom condo for like $30,000 cash. And, lots of reasons why you still wouldn't want to do that back then. But they were also giving away like BMWs. If you bought a car, I mean, if you bought a house, you got a free car. And I mean, it was incentives that, and just looking at this chart at a glance and seeing the number of Florida areas that are crashing, it just reminds me so much of what we experienced in the GFC.
So national home prices using the Zillow Home Value Index are up 1.2% March to March year over year. That's decelerated from the previous March to March of 2023 to 24, which was plus 4.6%. But as this decelerates, you're seeing more and more markets seeing declines. And actually, over the past 3 months, the number of housing markets in the country that have that are down on a year over year basis has doubled over the past 3 months. Actually, it doubled in a 2 month period, where in January, 31 of the nation's 300 largest, 10% of major markets had a year over year decline. That became 42 the next month, which is 14%. And then the following month, which this is the March to March, which was just reported last week, is now 60 markets. And so that's
Mm.
20% of major markets. But really, they have more they have more impact than the number sounds like because so much of these bigger markets are now down year over year. Tampa's down year over year. Phoenix is down year over year. San Antonio, Austin, Jacksonville, Dallas, Orlando, New Orleans, Atlanta, Miami. these are some big markets, right? And so, of the 50 largest markets, you had 6 of them down year over year heading into this year, and now it's up to 15 of the 50 largest. And my belief and view, my base case, is that I expect this 60 number to very quickly jump over 100 just based on what I'm seeing in the data today. And so this is the markets that are down year over year. You can see the 4 top: Punta Gorda, Cape Coral, Northport, Naples. These are all Southwest Florida markets. Then it's Austin, and Austin's down 4.6% year over year, but it's down 23% from peak because it's just been down nonstop since the second half of 2022. Uh, Tampa, Panama, I mean, you see the trend here, right? Where, let's see, three, four, five, six, seven, eight, 8 of the 10 down the most are in Florida, and the other 2 are Texas. And if you even go outside of that, just more Florida, Louisiana, Florida, Louisiana, Texas, Texas, Arizona, Florida, Texas, Florida, Louisiana, Florida, South Carolina. So when you were talking about earlier that the last cycle, uh, the biggest declines early on were, I believe you said, California, Florida, Arizona, and Nevada, right? This
Yes.
cycle, it would still be Florida, Arizona, but switch in Texas and Louisiana. Now, California does have some, and they saw more declines in the second half of 2022. But as of right now, the 4 with the most declines are Florida, Louisiana, Texas, and Arizona. And Florida, Texas, Arizona, a lot of that is driven by the boom was much bigger there. Louisiana is a bit of an outlier where, believe it or not, there are areas in New Orleans that are only up 5%, 3% from March 2020. They
Mm.
didn't see much growth there, but they've had some more economic problems if you dig into the data. And it goes to distress for credit cards, autos. They've seen lower income gains, and they are getting hit by just some huge insurance shocks there as well. And more of the short-term rentals have had problems there too.
Lance, when you're saying that this 60 markets could jump to over 100, um, where any idea of where you're thinking? Is it going to be more markets in these specific states? Because it looks like you've covered the major markets in the states where we're seeing it, like Florida and Texas and, you know, Louisiana, and I mean, California, certainly when we looked at the Zillow map, certainly some pretty big declines from peak to trough. Any thoughts on where we'll see this movement of this additional 40 plus markets?
Yeah, I think a lot of it's still Sun Belt, but I think it's gonna be more markets in, like, Tennessee, Georgia, Alabama is that's my base case, based on what I'm seeing in the data. You're gonna see some pockets more in the West that kind of, stabilized in 23, 24, and now, seeing a little more give up. You'll see it here and there in some of the areas in California and up into even the Pacific, North, west. I believe it or not, I think, like Burlington, Vermont will be like the first in the Northeast that I think we'll see year over year declines of the bigger major markets. And then I think a smaller market here or there in South Carolina and North Carolina as well. So a lot of the Sun Belt, and I think there will still be some more markets in the Texas, Florida areas as well. Although you've gotten it to where for this indice, which is single family and condo, uh, you've just about hit all the Florida markets now. Now that Miami's also moved into it.
Uh, Definitely, curious to
Actually,
see where this
well,
goes.
I didn't realize it. Burlington, Vermont is now on the list.
Okay.
It moved in. Yeah.
All right.
See, I didn't check the bottom, but these were some of the ones I've been keeping an eye on early heading into the year. Yeah.
Okay.
Huntsville, Alabama, you can see is now on there. Memphis,
Hmm.
Tennessee. See, I should have been checking the bottom of it. Durham,
Interesting. And Huntsville is said to be experiencing some of the largest employment growth. I think, isn't it Huntsville, Alabama? I mean, the FBI, a lot of FBI is moving there. I mean, you have all of the government defense contractors that are there. I think they've built up, the Northrop Grummons, the Lockheed Martins, and you have NASA, you have all these different areas. Surprised to see them on the list. I thought that area was
So
booming.
a part of it is that when it comes to booms and bust for real estate, you shouldn't necessarily think of them as the places that are like bad, like outlooks, right? Because a lot of times what happens is the places that have the best long term outlooks, where economists and analysts run the numbers and they're like, hey, employment growth the next 10, 20 years, 30 years is going to be great here. And you take an example like Texas. Texas should be in the next 30 years the largest state in the country and finally surpass California that's had the title since it took it from New York in like, I don't know, 1950, 1960, somewhere around there. And so Texas has a great long term outlook for Dallas, Austin, right? But because people are chasing that appreciation and there's so many people piling in, prices just in this moment go up too fast too quickly, right? They get ahead of their skis. And Austin gets up in 2022 to what, 2029, 2030 prices where you would expected them to get to. They just got there so fast, so quickly. And then once you see the migration cycle roll over, and in Austin, we'll see another migration boom. Dallas will see a bigger migration jump in the future. But when you decelerate from your high and it creates that demand destruction temporarily, where you have to rely more on your local incomes, even if they're rising, if you went up too quickly, too fast, you can get into a predicament. And that's the way that I would describe it, where some of the markets that do pass through home price corrections historically are still some of the markets that long terms have some of the brightest outlooks, right? You take a Las Vegas, you take a Phoenix from back in '05, '06, '07 that got way above their skis and saw a 50% peak to trough decline. It's not that Austin or it's not that a Phoenix and Las Vegas that saw that had bad outlooks. I mean, they've had good growth since then. It's that, they just went up too quickly, too fast.
Which would describe pretty much the entire United States, it's in a lot of ways, definitely. Well, Lance, let's talk about new home construction, because I want to I see that you post a lot with D.R. Horton, and maybe a lot of people don't realize, but D.R. Horton is a spec builder. They build the houses and then start taking orders on the ones that they have under construction. And you basically, you get it like it's slated to be. If it's, white cabinets or brown cabinets or, whatever, they basically, this is what you buy. We do have them here locally in Maryland, but we've seen a lot of the big builders. Their stocks are tanked compared to where they were just last year, and they do play a game with trying to keep the prices elevated and high. They play the inventory game also, because they really don't, when they're talking about inventory, the builders, there's nothing that requires them to post all of their lots on the MLS. So when we're talking about, inventory shortages in the news, people don't, in a lot of markets, they don't realize there's a lot of inventory that's shadow inventory that's not even posted. But the builders are very creative with their economists and their analysts and their attorneys and accountants and these Wall Street companies. I mean, they play it best, but D.R. Horton is like 120 of the top 500, publicly traded companies in size. They're huge. What are you seeing with them, and what is your overall prediction with how they're going to handle any kind of a massive downturn?
So, what the builders have been going through is that at the second half of 2022, when they had just these huge margins during the pandemic housing boom, and not too many people realize this, but builders on a gross margin basis, many of them were making more money during the pandemic housing boom than they were during the run up during the housing bubble before GFC.
Give us an idea. Give us an example of that.
Let's see how much do I have DR Horton's? Here's DR Horton's gross margin. So 2022 Q2, which is really the first quarter of 2022, they had a higher margin than they did in '05, right?
Wow.
And if you aggregate the builders, that's true on an aggregated basis for the builders. And so builders had so much margin that what a lot of them did at the second half of 2022 in these Sunbelt markets, so they took off 5, 10%, did a net effective price cut, right? Bigger in Austin. And they met the market heading into 2023. And the favorite lever for them, and this is what DR Horton CEO, previous CEO, David Adald told me before he retired, is the mortgage rate buydowns. And the reason is, and it's a little complicated, is that there's arbitrage in the market to where builders can cut prices. If they deploy $10,000 to mortgage rate buydowns, they can bring down the monthly payment more than they could cutting the price by $10,000. So that's a big part. It's part of it is they're trying to keep comps, and the other part is there's this arbitrage in the market right now, and it's based on where like the yield curve is. It's kind of complicated to get to it, but so they went out and they met the market. And so for 2023, a lot of these builders had a good year, despite housing being in this downturn and mortgages being so low and existing home sales being so low. Many of the builders did well because active inventory in a number of the markets was still well below pre-pandemic levels, and they had taken a lot of their margin and went and met the market, right? So I wrote a story and I called the big box builders, the publicly traded, the winner of the 2023 housing market. Then the first week of the 2024 housing market, or the second week, I went ahead and wrote a story and called them the winner for the 2024 spring selling season, which was still kind of the case and carried over from 23 into 24. Well, 23, 24, these builders, some of them might have gotten a little cocky because they had this favorable market where active inventory, despite us being in a downturn, was still lower than pre-pandemic, right? So they still had some power in some of these markets. And because they had taken some of their margin and met the market, they had, an advantage over the resale and existing, right? But as 24 went along and mortgage rates did not roll over like people thought, they stayed higher and active inventory continued to build, right? And is still continuing to build. The power dynamics here have shifted, where heading into 2025 spring market, Lennar came out and told investors in December that the market has shifted more, that they are going to go and they want to continue to maintain sales. So they are going to cut their margin even more and do more price cuts and net effective price cuts. And so Lennar stuck to its guns. And on a year over year basis, net new orders for Lennar is actually up 1%, but it came at a cost. Their margin compressed by 3 percentage points year over year, and their margin that they had told investors would be around like 19.5, 19.2 came in at 18.7% gross margin for Q1 of this year, which was lower than expected and was their lowest since over a decade, right? A decade low for their margin. And the reason is that they had a 13% incentives rate on their homes, where, like I gave the example earlier, on a $400,000 home, they're, taking $52,000 towards incentives, whereas at the height of the pandemic housing boom, they had an incentives rate of 1.5%. So it'd have been like less than 8 grand going towards incentives. Now, DR Horton's margin has compressed as well, but not as much. And the reason is they've actually started to pull back a bit in Florida and Texas, is what DR Horton CEO told us on Thursday of last week, told investors. And so they haven't pulled back their margin as much. And so that's led to a bigger decline in their sales. So orders for DR Horton are down 13% year over year. And if you go across the country, in the north markets are places like um, Delaware, Illinois, Indiana, Ohio. These are subjectively created groupings by DR Horton. but it's also like it's a huge part of like the Northeast and Midwest, pretty much, and they're pretty much flat. Then the East markets are down 4.5%, and those are Georgia, Carolina, Tennessee. Northwest is Colorado, Oregon, Washington. It's down 14%. South Central, that's pretty much Texas, down 15%. Southwest is down 23%. And that is like Arizona, California, Hawaii, Nevada, New Mexico. So a lot of Arizona is like the big one there. And then the Southeast is down 26%. And their Southeast is really, I mean, it's Florida. That's the epicenter of their Southeast market. So they are seeing margins still come down, but they have not cut prices as much. And so the result of that is that their sales are falling. And this chart here is their homes in backlog and their net new orders for every second quarter going back to 2002. And this took a long time for me to research and get all this
Mm.
data. And their Q2 ends March 31st. It's a fiscal one. So it's really like a calendar year Q1. So it's early spring. And you can see that their backlog really shot up during the pandemic housing boom as they had complete pricing power and they were able to sell, they were able to sell more homes than they could build pretty much. Right. And then it also got driven up by the fact that there was supply chain issues, right? And they couldn't build as quickly as before. And so their backlog has been rolling over consistently since the height of the pandemic housing boom. And you could see net new orders did start to decline Q2, Q3, but then they had a really good Q4, but it's kind of been a bit of a head fake where now they're rolling back over. And so it'll be interesting to kind of see where things here are, where things head for DR. But you can tell that they're being a bit more conservative now if you look at this backlog that's rolling over, right? Where some of this is, kind of catching up with the supply chain issues. Now, as it continues to roll over, it looks like they're kind of getting conservative here.
Well, I can speak to just leave that up for a second. Looking at, these numbers, I know they were really incentivizing to utilize their rate buy downs. They were offering really low rates. D.R. Horton, I'm talking about. I had a client that did buy a D.R. Horton home last year. Their incentives also for real estate agents spiked as well.
Yep.
So a lot of that is, if a real estate agent who has a buyer, it's like, they're guiding like, oh, wow. So D.R. Horton's offering all this money if they buy a D.R. Horton. That's not why I actually did everything I could to sort of, show them other houses in the market as well. They like the location of this area and they wanted the D.R. Horton home. But I experienced during the peak of the pandemic boom, builders weren't offering anything to real estate agents. I mean, it was really low, right? And so I experienced where a whole lot of incentives have just they're coming out right now, trying to get everything they can to everybody they can to walk through their properties and to buy their new home construction. Who's smarter here, Lennar or D.R. Horton? So Lennar's dropping prices, meeting the demand, selling more houses. D.R. Horton's holding firm, saying we're not going to meet the demand as much. We're going to stay true to our pricing, and we're going to deal with the lack of sales. Who's smarter?
Well, one thing is that D.R. Horton's also starting to pull back on starts more, right? In places like Florida and Texas. Lennar is moving forward. Now, maybe they're starting to pull back in Southwest Florida because it's gotten so choppy, but Lennar keeps pushing forward as they chase volume. So
Lennar's building sort of like a speculation type of build like D.R. Horton does. I thought Lennar was you sit down, you sign a contract, you buy it, and then they start constructing your home. I know that they have a lot of mounting inventory where the deals fell through, but is Lennar now backlogging pre-construction?
I want to make sure that I get this right and don't get it wrong. I could follow back up with you, but I'm
Okay.
pretty sure that they had a bigger push for speculative starts for
Okay.
2024.
Yeah.
Um,
I mean, I know my local market. I don't know, I'm not tracking it like you
and
are, Lance.
the other thing is some of these builders now they've shifted some of their strategies in some of these submarkets as well. And whereas some of the narrative for some of these builders is kind of shifted over time in terms of what some of their strategies are.
Yeah. Well, all great information. Guys, I hope you're enjoying this with Lance. I mean, he's tracking the housing market. I don't know anybody that is tracking it as much as he is. And we're just so grateful that he can come on the show and share this data, share this information. If you want to hear from Lance more, drop it down in the comment section. We'd love to bring Lance back on a consistent basis. We're talking about maybe doing a monthly show where we get these updates every single month. Let us know your opinion on doing that in the comment section below. All of Lance's information is in the show notes. Lance, I can't thank you enough once again for coming on and sharing this data.
Anytime. Thank you for bringing me on, and thanks for having the discussion and letting me go in so many different directions here.
Absolutely. Well, I'm looking forward to tracking those additional 40 markets that you're predicting that are going into the correction or price decline phase throughout the United States. It's definitely going to be something interesting to watch, and we're so glad we have a resource like you.
Thanks for having me.
Talk to you soon. Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.